A Euro US dollar 60-minute chart. Once again, I want to show you just how price respects and references previous levels of resistance and support. Once again, this is going to become very important when it comes time to understanding the optimal places at which you will enter the market for your trades, and also it will be critically important for managing your positions, understanding where to place your stops, where to place your limit for profit orders, as well as understanding where price will bounce while you're in your position, and so that you can understand where price is in reference to the framework within which you're working and the tools that you are operating with for that specific trade. We see here price is trading at this level of support. It moves below, distinctly moves below, and trends down, and again bounces up at this high here, and we see a nice bounce, consolidation. Price moves and commits above. Traders do not want to take it below these reference points, and we consolidate. Here we see some stimuli comes into the market, perhaps an economic report. Price jiggles around for a little bit. A retracement and a rally up above this key high. Now, you might be asking yourself the question, or me the question, under your breath, well, why would he take the high of that wick and use that as the price reference point for the base of support in the future, where here he simply cuts through the wicks at the highs and cuts through the wicks at the lows? If you haven't already asked that question, then I thought I'd bring it to your attention. The market's not a perfect place, and let that be a revelation. The market is not a perfect environment. Price will slip through, and although this is a 60-minute chart, maybe price slips through by 5 or 10 pips, where you may see a similar chart pattern or price pattern on a 4-hour chart, and it may slip through by 20 or 30 pips, whereas on a daily chart it might be 40, 50, 60, or 70 pips. You see the wicks. I like to focus on the bodies because that is where the primary, the bulk of the volume has been traded for that time period. So I use my support and resistance levels fairly loosely to establish the price reference points that the dealers are taking. Now, it's quite possible, or it's really not difficult to conceive the possibility that as traders deal in this range, there's nothing to prevent traders from pulling price down errantly to points beyond a very specific and exact price point. And we have to be loose with that, and we have to understand that when we're entering our trades, because these prices will come down against our position, and we simply have to trust our tools. For example, these ones come down and spike more directly towards the highs of this consolidation here. But again, I just use the line as a loosely referenced tool with the understanding that price will slip through here at times. So let's just continue to walk through this, and we continue to see price moving forward as the price levels change, as does the support and resistance levels. We see how price respects these levels. Now a stimulus comes into the market, and price bounces at the lows here, continues forward. Price dealing in a bit of a sloppy range here during the peak of New York session. This move here was London session. Let me see, a UK economic report. No. Early Central European trading. Moved it down at the open of Central Europe, price gets choppy during the New York session. As price consolidates into Asia, Asia pulls it back, and London now opens, establishing a level of support, quite a clear level of support. And if you see price trading in this range here, and if you anticipate that we're going to have an up move, you want to trade it as close to 2800 as possible. $28.40, a protected area as price moves through. Trades above for a couple of hours before pulling back. We see here that price committed above 28.40 and traded there for a few hours and then pulled back sharply here. Well, there's nothing we can do about that, and that's going to happen from time to time. Again, it's an example of the market not being perfect. And at this point, as price moves through, the next target area I would look at is 2800 for a bounce. We're not talking yet about trading. All right, we're just looking at we want to get an understanding of the market and how it works in order to help us to make our trades and manage our trades. However, I will trade on support and resistance alone sometimes, but it always plays a part in my trades. It has a place in every trade that I manage, which is why we're walking through this exercise now. $28.40 still our level of support. Looks like it. We see the market is making higher highs and higher lows. I would anticipate that $28.40 could hold here, and if I think the $28.40 is going to hold, then I would trade right here as price dips down to $28.40. I would want to trade long straight into that candle. Now we begin to commit above. So now we're at approximately $28.60. Now price consolidates and trades above. If you think that we're going to have another leg up, then you want to trade as close to this low as possible. You see here how price slipped through, because you may have an opportunity to profit even if it just comes up and tests this high. Now we move through again. Our next targeted level would be 29.20, 28.40 to 29.20. There's about 80 pips, and we are seeing some weakness here. Price rallies above, comes back, tests the last level of support. We see price whiplash. It spikes up to 29.20 and rejects. Now it looks as though we are going lower. If price starts to trade below 28.80, then we are moving lower indeed. $29.20 is a high to $27.20. That's a lot of volume. For volume to push price from $28.40 to $29.20, then all the way down to so far $27.20, that's a big move. What I mean by this is that there must have been a lot of orders flowing through the market that day. It would have been a high volume day in the market. Now $27.20, highly unlikely it's going to penetrate these lows today. We are now consolidating below 60, establishing a high. And if you think this is a low, then if we see a move down here to 27.20 again on this day or the next, then you want to trade it long. with anticipation of a retracement. You could trade it long here, 27.20. But we need to see price now move out of the range. So the low is 27.20. The high of the next candle was 45, so that's a 25 pips in spread. So it's 20 pips. We spike up another 5-10 pips. Now the price is holding above this resistance level. We are likely to see another leg up. As we see price continue to consolidate above this level, we are likely to see a leg up. Price threatened to the downside for a moment, but continued to trade, but didn't hold very long. Now price is moving above this high here, and we may see it come back and test, which is characteristic. Let's take this guy and move him down here. We're through there now though. Comes back, tests the previous high, holds above, winds up and moves above 2800. Here's our dealing range, 2800. Comes back and tests. Comes back and tests. So again, if you're watching these ranges, you can trade when it comes back and tests. I would look more towards the body of the candles where you want to go long. If it comes back and tests around the body of the candles. You see here the body of the candles, the body of the candles. Trade long as price comes down to test the body of the candle. Trade long as price comes down and test the body of the candle. Trade long when price comes down and test the body of the candle. Look, even on this reaction alone, if you traded this long here, price moved in excess of 30 pips. Now price is winding up. The market is winding up for another leg up, it appears. Pushing through one last time before the session comes to a close. And there we have it. For a period of several days, you see how the market made sense for a period of 6, 7, 8 days. As long as the market is making sense to you, you can trade it. Look at this nice trade here. Nice trades here all along the way. Many small trades to take advantage of.